Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us remotely, I have April Rudin. She's the CEO of the Rudin Group. We're going to take a look at how millennials will approach investing on the other side of COVID-19. April, it's great to have you with us as always, and I'm really glad that we're bringing this up because we're looking at how the economies will recover, how larger companies are going to recover, but we haven't spoken about millennials or the younger generation and how they are going to process everything that's going on right now, because for many of them, and this also includes Gen Z and some other younger folks, they have never understood what it's like to go through a significant pocket of volatility like we're seeing now.
100%. I mean, whereas it's new for all generations and all people, right? This is the black swaniest event we've ever had before. It's certainly new for millennials and Gen Z to figure out market volatility, where safety is, and what they should be doing.
Yeah, and you're thinking that you might see less green and more blue. What do you mean by that?
So exactly. I mean, from where I sit, I think that millennials are going to start thinking less green and more blue, meaning less about green investing, less about impact investing, less about sustainable investing, because those perhaps won't hold up under the lens, and will be moving more toward safety in some of the larger brands, so more toward blue chips. So that's what I mean by less green and more blue. I think millennials and others are going to be less likely to move into riskier stocks, riskier investments and things, and will have a strong move toward strength and a good balance sheet.
Well, if we take a look at your next slide here, an article in Forbes citing some stats from Morgan Stanley, the millennial generation is going to inherit trillions of dollars when we see that wealth transfer, and 95% are interested in sustainable investing. It might not be the case moving forward.
Yeah, exactly. So, in a few short months, we've seen things really change dramatically. And I think this particular area is really an inflection point for people in wealth management and corporates to really take a look at. This wealth transfer, which we're firmly in the midst of right now, and also millennials are the greatest generation and represent the most number of entrepreneurs that we've had. And so when we take a look at their investing patterns and we think about where their propensity was, it was definitely more toward sustainable, responsible impact investing. And that was huge. And I think that that will still remain some impact, but I think that we're going to see a real shift in moving towards some of the blue chip stocks. And I think things are going to change very quickly.
All right. And in addition to moving from green to blue, and we saw a number of trading app glitches, some of the newer ones that have come online just because of the volume and the volatility that we've seen over the past 5-6 weeks, perhaps they might look to going back to blue chip financial services, if you will.
Yeah, so even in the slide on EV, where there's a blog on there, which is a millennial blog, a millennial magazine site, and there was a blog that I found, which is called "Why the Corona Market Collapse is One of the Best Opportunities for Millennials to Invest," and it really breaks down for millennials why things are sort of on sale now, and how these stocks really are not market timed, and so they can really go into these stocks now. One of the funniest things I saw was this sentence here, which is a key on the eye on the oil majors, where like ExxonMobil. Now, look at the way ExxonMobil, I'm not sure if that's a typo or that's just representative of the millennial generation thinking that Exxon is maybe a mobile company. Maybe they're a fintech.
And you know what? Even before I read that, I also see, should it be keep an eye, not key an eye? It looks like there's a couple of spelling errors in there, but I that's the reporter and editor in me. All right, I want to take a look at your last two slides here, where we're looking about investors, younger investors getting wary of perhaps newer financial trading apps, looking to go back into bigger financial brands, more established companies.
Yeah, so I feel like some of these trading apps, like you mentioned before, I mean, Robinhood had some trading glitches, had some outages, had some, serious performance problems. And I think that is a cause for pause for some generations, particularly millennials, if that's the only thing that they've ever traded on. For other generations, they may move to a couple different trading platforms, let's say. So that was sort of happening before this current turbulent times that we're in right now. But what I foresee happening is that the big financial brands really have an opportunity to establish themselves through thought leadership and marketplace dominance on their safety and security. They've been around since 2008. They've been bolstered by a lot of what's happened, and that story has not been told. So I think that there's an opportunity for these big brands to probably gobble up some of the fintechs and bring them under their big tent, as I said here, and then be able to also have a renaissance for managed accounts. So I think moving from passive to active is going to be something that we're going to see as well. People are not going to be able to mentally and psychologically be setting and forgetting it. They're going to want to keep an eye on their money a little bit more closely.
All right, April, appreciate the insight. Thanks so much for joining us as always.
Thanks, Jill.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.